This is an uncovered Japan company research report on JCU Corporation, ticker 4975. JCU is a Japanese specialty chemicals maker whose copper plating formulations are used in the packaged substrates beneath advanced chips. The business combines unusually high profitability with clear AI and data center exposure, but its shares already reflect much of that quality. The starting snapshot is unusually strong for a listed chemicals company. JCU earned a 41% operating margin in fiscal 2026, a level roughly triple a typical chemical sector margin. Return on equity was 17.7%, and the equity ratio was 87.1%. But the market is also valuing that quality at 19.5 times forward earnings and 3.14 times book value. JCU does not make bulk chemicals. It formulates liquid plating chemistry that deposits, etches, and finishes thin metal layers, mostly copper, on a customer's product. Its electronic formulations help fill vias and build packaged substrates and circuit boards. Its decorative formulations go into automotive trim and fixtures. Customers buy a tuned recipe for their own line, so the value comes from formulation know-how, process support, and qualification, rather than from the basic chemical inputs. The group reports two segments, but they are not equals. Chemicals accounted for 91% of fiscal 2026 sales and delivered a 47.2% segment operating margin. Equipment represented the other 9% of sales, with a lower 15% margin. Equipment orders can be volatile, but the business gives JCU a strategic route into a customer's plating line. The chemical segment is the earnings engine. Equipment helps seed and support that relationship. The financial history shows why the market rewards JCU. Revenue reached a record 29.7 billion yen in fiscal 2026, while operating profit rose to 12.2 billion yen. Over 5 years, revenue compounded at 5.2% and operating profit at 7.8%. Fiscal 2024 was the one visible dip when the semiconductor cycle weakened, but the company recovered through fiscal 2025 and set new records in fiscal 2026. JCU pairs its high margins with a notably conservative financial structure. Its equity ratio reached 87.1% in fiscal 2026, while return on equity recovered to 17.7%. The report estimates roughly 24 billion yen of net cash. That balance sheet strength gives management room to fund research, expand capacity, and return capital without relying on heavy financial leverage. The moat is not a patent slogan or a single machine. It is a qualified relationship built around customer-specific formulas, production line tuning, and local technical support. Changing a chemical supplier can require requalification and introduce production risk, which makes a proven formulation sticky. JCU reinforces that position by selling equipment and process controls alongside chemistry, then supporting customers across its 7-country footprint. JCU's growth exposure is real, but so is its geographic concentration. More than 83% of sales are overseas, with China accounting for 39.8% and Taiwan for 15.4% in the report's geographic view. Electronic chemicals account for roughly 82 to 84% of chemical sales and serve the East Asian manufacturing hubs for packaged substrates and related electronics. A weak yen is helpful, while US-China restrictions, regional cyclicality, and currency reversal remain material risks. Management's strategic ambition is to lift revenue from 29.7 billion yen in fiscal 2026 toward 50 billion yen by fiscal 2035. The plan is anchored by the new Kumamoto Research and Production Hub and the Tip Harris Advanced Packaging franchise. The target requires about 7.7% annual revenue growth, so execution depends on continued adoption of advanced semiconductor packaging, successful local capacity ramp-up, and the ability to offset a structurally weaker decorative plating leg. The valuation is where the case becomes more balanced. JCU earns superior returns to its plating chemicals peers, but it trades at 19.5 times forward earnings, compared with roughly 8 to 14 times for the named peer group. The premium is understandable given its 17.7% return on equity, advanced packaging exposure, and net cash. Still, a premium multiple creates less room for an earnings miss or a semiconductor down cycle. The report frames outcomes as scenarios, not price targets. Its 3-year bear case is 5,760 yen, about 17% below the then-current 6,960 yen. The base case is 8,160 yen, about 17% above, and the bull case is 10,560 yen, up 52%. The bear case pairs a chip downturn with margin pressure and a lower multiple. The bull case requires stronger AI-driven packaging demand and TLPHAS penetration. JCU is a rare, high-quality specialty chemicals company. 41% operating margins, a strong balance sheet, long dividend growth history, and credible exposure to advanced semiconductor packaging. The counterweight is valuation. At a 5-year high multiple and a premium to peers, the investment story depends on sustained execution through the next semiconductor cycle. This report is educational research, not investment advice. The judgment and risk sizing are yours. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.